Hello, everyone. This is Andrew Berman from American Business Media coming to you for another NMP webinar. You are watching the last and final episode of this season of the non-QM Town Hall. I am so excited to wrap this up. We've had a great season, man. I mean, we've really done some great things. I think if you look at some of the people that I've been talking to from when they started this, from where they are now, I mean, people are ready. Most of you guys are in a better position to execute a non-QM. I think it's going to be a great year. So just going to quickly introduce my legendary non-QM masters that have joined me today. In no particular order, we got Mr. Robert Senko of ACC Mortgage. Mr. Senko, say hello.
Thanks for having me. And you said there's going to be some legends on here. I don't see anybody. I mean, it's just a couple old dogs on here. So I'm looking forward to meeting these legends.
Well, I have multiple personalities, so that can be considered legends in my own mind, at least. And then next we got Mr. John Wise over at NewFi. John, thank you for joining us today with your fancy background there.
It's great to be here. I'm up in our corporate office today, and usually down south in LA. But yeah, it's great to be with you guys again. It's been a fun 6 months getting on with you guys every month and talking about the non-QM business. And so yeah, just I'm a little bit sad. We're ending the series today. Got a little tear in my eye because.
Well, don't worry. For our audience, we have actually some great things in store for next year. This doesn't have to be a permanent goodbye. This is just a goodbye for now. And last but not least, Tom Davis over at Deephaven. Tom, thank you so much for joining us again today.
Yep. Hey, hello everyone. Happy holidays, Merry Christmas. I've had a ton of fun with this group. These are all superstars in the mortgage and non-QM space, and it's been fun. So for me, it's been it's great to get on these calls with our friendly competitors, and I feel I have a great relationship with my friendly competitors, and so it's been great to as a group, drive awareness in the non-QM space and really help originators, push through 2023 and looking, into next year. I think we got a lot of tailwinds behind us, so we're super pumped about next year.
Let's do it. Fantastic. Well, listen, and I'm just going to add my 2 cents here. So, listen, there's a lot of companies that you can work with and partner with in terms of non-QM. 3 of the best are represented here. Particularly these companies, these guys are non-QM focused. So I just there are plenty of companies that do non-QM as part of their service offering. And some of them we work with, and not saying they're bad, but something, these guys are dedicated to non-QM. That's all they know. I don't even think they could write they couldn't write an agency loan if their life depended on it. And this is a good thing for your non-QM strategy. So here's what we're going to do. I'm going to launch a quick poll. I got a bunch of questions, but please, I want your questions. This is the, Ask Me Anything, episode of the town hall. So we want to hear your questions. Give it to us raw, and then we'll just kind of do a little recap. But first off, we'll start with a little poll. I want to know if you're ready. So let's see. Let's talk about this. So looking at your 2024 push for non-QM, are you prepared? Yes. Not ready yet, but you will be. Still need to get ready, or people, they're not sure if they want to do more non-QM in 2024. It's okay. And a lot of people are skeptics, and they're just coming in here to get a gauge. Is this something worth pursuing? So we're going to keep this open. We've already got 38% of the room that's voted. So we're going to keep it open for probably about another 10 seconds. We're at 45% of the room has voted. Okay, we can go 5, 4, 3, 2, and 1. Okay, we just hit 50%. Everyone, thank you so much. And please, by the way, also use the chat box to actually share any of your comments. We're going to include those, and make sure you use that question and answer box. All right, so we're going to share this right here. All right. And So everyone knows, sometimes we share the recording, sometimes we don't. At the end of this, we're going to look at this and say, all right, listen, did we say anything actually that we shouldn't have said on this? And if we did, this might not ever see the.
And it's not going to be a good webinar. What's the
Yeah.
event?
Thank
We're not
goodness.
shocking. Well, come
Thank
on.
goodness.
Come on,
Exactly.
Andrew.
We want to be raw. We're going to be raw on here, so that's why you want to stick around. Don't actually wait for for a recording. So there we go. 67% prepared. Now, we should have asked this question 6 months ago to see what they would have said, but 61%, 67% are prepared, 51% not ready, but will be ready. 13%, they need help. They're looking for a little assistance. 5% just not sure yet. So I appreciate that. The 5%, probably the most honest people actually in the room today. And I like that. I appreciate that. Gentlemen, any commentary on this, these results here?
I mean, I think the one I'm mostly concerned about is the 5% that aren't sure. Like, if we haven't convinced you by now, you've been on 6 of these, and we haven't convinced you, then we haven't done our job. What we're finding is that the non-QM space is growing significantly faster in a market that's shrinking. And so if you're not sure about non-QM, then your business is probably shrinking with it. And we see people that are embracing the non-QM space as the ones that are actually growing in this market. So I'm thrilled to see the 67% are absolutely ready to tackle it in 2024.
Hey guys, here's an idea. Why don't we go do a one-on-one with those 4 people? We'll have a private webinar. The 4 of us, the 4 of them. We'll get them excited. That's the crew. We'll do it one more time.
That was
I was going to say, I think the middle, those other 2 questions, and not sure, or would like to be but not ready. That's opportunity, right? So those folks, have an opportunity to really focus on the product, learn the product, and with that confidence, you'll be ready to go in 2024. So yeah, I know Deephaven, we would love to help you, become more confident, learn the products, and help you grow that business.
And guys, can I just ask you each a favor? Can you reach out to everyone that's on this and just offer your resources? So Robert, John, Tom, just share your resources, because I know each one of you guys have tools. You have flyers, you've got presentations, you do webinars, you got so much resources. So let's just arm these people with as much resources as we possibly can, so we can have an amazing 2024 that is fully taking advantage of the non-QM space. So we good on that? You guys will do that?
Absolutely.
Fantastic. All right, so we're gonna go to some questions here. I got a handful of questions. I appreciate everyone who's submitted some questions. So, all right, we're going to start off here in no particular order. So listen, do you see non-QM space increasing next year in terms of origination? So, listen, I mean, but we have rates increasing. I'm sorry, rates going down. At least that's the trajectory that we're looking at. 10 years looking really, really nice these days. But so where's non-QM going to fit in next year? First off, John, why don't you take that, because you're on my screen. And then Robert, will go to you, and Tom will wrap up with you.
Yeah, we were talking about it here internally yesterday. It's an interesting time, 2024. The non-QM space we're a decade in. Obviously it had a different name, prior to the Great Recession. But we're a decade in, and the first, I don't know, let's call it 6 or 7 years, it was really just kind of good growth, good solid growth, building, growing. And then we hit a rough patch in March of 2022, and everybody kind of went to zero and reset. And then 2021 was a good, healthy year for most people. And then all of a sudden COVID hits, and everybody's attention shifted to agency refis. And what I'm feeling about 2024 is just an incredible amount of excitement, because you're going to have a market that's going to be growing again in the mortgage business, just in general. And now that non-QM is part of the lexicon of the mortgage business, I think you're going to see growth similar to that increase. I think the MBA is projecting a 23% increase for next year over this year. It's exciting for the mortgage business to start growing again, and I think you're going to see non-QM grow in the same kind of fashion. And so, yeah, I'm incredibly excited about the opportunities.
Fantastic, Robert.
Yeah, I mean, There's a couple layers to this question. Non-QM needs to be a tool in your belt. So for the originators, people are trying to get into it. People have done it, and there's some really good questions. I know we've seen a bunch of these questions, and we'll get some flowing in, but it's got to be part of your product mix. And when I think about things, I say this all the time. Tom and I did a webinar earlier this week that, I try to speak to the loan officer out there. There's a lot of professionals on these, but I think about myself starting out, and where my career was defined by separating myself. In the agency world, like Andrew said, none of us can barely even spell agency, but non-QM, we get the letters there, so it makes it easier. This way you need these tools. And to me, non-QM, or whatever the name, that we called it, B and C, Alt-A, it separates you. And anyone can go, because the agency is a commodity. What's your rate? That's the question. They're not going to ask you anything special. They're not going to talk about, but non-QM, you're solving a problem, and that's the separator. So if you can solve that one tough one from your referral source, there's hopefully 2, 3, 4 more behind, because you really were the hero on that deal. So that's why it's so important. We could talk about perception of what we think 2024 and beyond are going to be, but the people that survive, and I think about myself, are during these down markets, but you separate yourself, and non-QM is the separator. So that's why I'm so passionate about it, and John and Tom are so passionate, and we get out there to promote it.
Fantastic. Tom, talk about, how,
Market bullish, super bullish. Look, this year's been a tough year, right? Earlier on in the year, we saw rates really, increase dramatically. Over the last 6 weeks, rates have come down. Fed yesterday has signaled that there's going to be some rate cuts in the future, so we saw the market move. I think we continue to get more economic news that will come out that's soft, and rates will come down. That'll be good for the overall market. But industry experts, including Deephaven, we're forecasting the market to grow from a 38 billion kind of number to 50 billion next year. So a 30%, 35% year-over-year increase. And Robert talks about it all the time. This is solution-based lending. You need these products to compete. You need these products to stay relevant, to tap into new referral sources. And non-QM serves our borrowers in our country that are very entrepreneurial spirited. There's over 20 million self-employed people in the United States, or close to 20, that account for 30 million businesses. There's over 17 million investors that have over 19.95 million investment properties in the United States. There's over 40 million people in the United States that weren't born here. There's credit event borrowers. The economy's kind of things are slowing down, right? So I think we'll see more credit event borrowers. Delinquencies are increasing in credit cards and auto loans, so there's an opportunity there. As far as equity, there's over $29 trillion in equity, so there's opportunity for second liens. So if you add up all that group, right, there's a ton of opportunity. If you don't have non-QM in your toolbox, you're at a competitive disadvantage, and someone's going to be taking your market share, and they're going to use non-QM to penetrate your realtor relationships. So you got to be armed to go to war next year, and either you win and you take business, or someone takes yours. Which side do you want to be on is the thought.
Yeah, I mean, the other thing that I would add, Andrew, that I think is important to talk about, especially for originators, is the borrower credit profile has changed over the last 5 to 10 years. And the agencies are really created to manage a pretty simple borrower. And the credit profile of the borrower has changed, and so it's much more complex. I mean, how many people do you know that are using that have an ADU in their backyard and picking up rental income? How many people do you know that are renting their room out to somebody and not getting any credit for that income going forward? How many people you know have second jobs and third jobs and gig jobs? And this borrower credit profile is changing, and I think the private space that we represent on the non-agency, non-QM side, certainly here at NewFi, is trying to be adaptable to that market, and at the same time creating loans that pay. That's the most important thing for us. going forward is creating good loans to good borrowers and trying to adapt to that credit profile. And it's an important thing for originators to keep thinking about. So if you come across somebody and you sit down and say, well, okay, tell me how you make money. It's not just your salary job. What else do you do? Do you sell? We heard a story this morning on our scenario call where somebody had a W-2 job, but they were selling soap at the swap meet and making money selling soap at the swap meet. And that's a source of income that people don't really think about. And originators need to be talking to their borrowers about what are the other ways that you're making money, and whether or not I can use that income to qualify is the question that you got to be asking.
Can you make a lot of money in soap? Is there money? Maybe, my wife.
Clean business.
Okay,
It's a clean business. I like that, Andrew. I like that. I like that.
All right, gents. And if we can, because we got a bunch of questions, a bunch more coming in. Thank you, everyone, for participating. Keep those questions coming in. Let's try to do 30-second responses. Boom, boom, boom. I want to get to as much as this. Okay, this one take a little more time because this is a good one, because a lot of people are on the call and have shared. They want to know what to say, what to do, actually, whether they're having conversations, whether they're doing presentations. So this is the one from Piper. I appreciate this one. What is the biggest questions we need to ask our clients, that most are not asking before running scenarios with you? So what are the biggest questions that we need to ask our clients that most are not asking before running scenarios? And Robert, if you want to take that one first, then we'll go to you, John, then Tom, you'll wrap that up.
I was reading some of the questions in there. So, what are you saying? Ramp up the business?
So the questions that you need to ask your clients to find these opportunities. So what are the biggest questions that you should ask your clients, before running scenarios with you?
Gotcha.
Are there things that they could be filtering before they're bringing to you and saying, okay, not a deal?
So normally non-QM, my standard joke, but there's new people here. Non-QM is, like my marriage. I wasn't my wife's first choice, but turns out I was her best choice. That's non-QM. So when a client comes to you and they're looking for a loan, typically, or you've been the originator, you tried to take them conventional agency, you're going to know what the problem is. So how we train our team and how an originator should say, what's the problem? Why didn't you get this loan? Why do you think prevents you from getting this? Get the problem out front. Don't go through this discovery weeks in, appraisals ordered. What's your challenge? Well, my my W-2s, or my tax returns. So you get to the core issue of why this may be a challenge. And when you do that, then you can adjust, whether you're going a bank statement loan, a P&L, or if they're buying investment property, you can go DSCR. We don't need your tax returns. We're going to look at the cash flow of the property. And I know we'll touch on that at some point. So get the problem up front. I think, new originators and folks are afraid to ask those difficult questions at times, but ask that hard question and get it up front. You get that, then you can build a solution from there, as I touched on before.
Fantastic.
Yeah.
John?
Yeah, great. It's a great question. And so one of the things I talk about all the time is, if you're a loan officer doing full doc loans, agency loans, jumbo loans, you're thinking about adjusted gross income. You're thinking about that bottom line number. And that's really what people are focused on in the origination space. Once you get to that number and you say, oh gosh, the adjusted gross income is $10,000, you write everything off, you got $1 million of revenue, but you got $950,000 of expenses and your adjusted gross income. So that's where people start on a full doc loan. What I'm suggesting is on the non-QM side, certainly on the bank statement side, you should start at the top line. You should be thinking about top line income. That's really where we want you to be focused. And if you're looking at a top line income on a set of tax returns and they've got $1 million of income, that's where you need to start thinking about, do I have a deal? Because that's the big difference between underwriting a bank statement loan versus a full doc loan. Is full doc loans, you're looking at that bottom line. And so that's the biggest piece. And I love the way Robert goes about it, because again, you're solving a problem. So is this the first time the borrower has applied? Do they know that they don't qualify for a full doc loan? Have they been rejected other places and they know they have a problem they're trying to solve? That's a different conversation, because then they're coming to you and saying, I already have been rejected and I have this problem to solve. And then you got to start asking those probing questions that Robert's talking about, is what's the problem, why you get there. But start thinking about top line revenue versus adjusted gross income would be my biggest recommendation for originators, and then solve from there.
Ooh, great. Biggest questions we should be asking our clients that that most are not asking before running scenarios with like your scenario desk.
Yeah, I would say understand the income, as John said, understand, ask, be thorough when talking to your borrowers, understand the business that they're in. If they're self-employed, obviously, non-QM serves self-employed borrowers. Just develop the entire story. I would say also develop assets. Just because they don't qualify their bank statements, you could actually utilize the assets to augment the income. And so many times files get declined at other investors because they just go off the bank statement income. They don't know, and you're using 50% of the income. They don't dig in to understand, their expenses in that business. The standard expense factor is 50%. You could actually use lower than 50% if you have a letter from the CPA. Certain businesses don't have as high expense factors. Some businesses might have a 20-25% expense factor, and that could be the difference between a deal or no deal. And then the other piece is, once again, going back to the income. You might be really close on the assets, but then, or on the income, on the bank statement income, but then you have they might have some assets, and you could actually use that through asset utilization. You take those assets divided by 84 months, and then that's additional income that you could add to the overall income to help you qualify. So that's why I highly recommend working with an account executive that's skilled, that's an expert in non-QM. Work with someone that is a pro. They're not someone that's not dabbling in non-QM, but is an expert and is focused on it, because the account executive is the one who can help you structure the deal and make the deal get it approved, versus it being declined and you having a bad experience and your referral partner's having a bad experience, right? So at Deephaven and the other folks on this call, we all have seasoned account executives that are experts, market experts in non-QM.
Hey, Andrew, the other thing too is it also depends on the type of borrower you're talking to. So we've been talking mostly about bank statement borrowers, but one of the questions that comes up all the time on an I-10 borrower is credit and credit profile. So I think one area where loan officers can be a real value on the front end on I-10 loans is helping I-10 borrowers develop a little bit of credit, so that getting access to a mortgage is a little bit easier. We see a lot of really thin credit files on I-10 borrowers, and if originators can get in front of that by helping borrowers identify the responsible use of credit before they apply for that mortgage, kind of develop themselves for 6 months or 12 months, it'll put them in a lot better situation. So we're seeing a lot of that. So when you're reaching out to that I-10 borrower, just make sure you're developing that credit profile.
Fantastic. All right, next question. What are concerns about buybacks? Any red flags to kind of be concerned about?
I'll take that.
Yeah, Tom?
Yeah. So look, if you look at just delinquencies overall in the non-QM space, securitizations in general, actually delinquencies have actually ticked up on 2023 vintages versus previous years. And if you dig into the data, the reason for the delinquency on it's still relatively low, but what we're seeing is in securitization is products that you don't get a full view in income, right? So you're not seeing 12 or 24-month bank statements. You're seeing delinquencies pop up with just a P&L only and not looking at additional bank statements. That's an area where we're seeing higher DQs. You're also seeing delinquencies, a high LTV cash out as well. So that's where I'm seeing
But they're asking
And
about
so-
buybacks. They're asking
Oh,
about
buybacks. Yeah. So if you have a first payment default, right? So that's where the DQs are coming in, right? So as an investor, you got to be careful about what you're putting out to your customers, because you don't want them to originate or put a product out there that has higher delinquencies or first payment defaults, right? So we've seen some of that, but we just got to be relentless when it comes to having product in the marketplace. But I think you could see potential buybacks increase, and also early payoffs, right? We're seeing rates come down. People are going to want to refinance pretty quickly. So that's another place I think that we're going to have to be looking at pretty closely.
Well, outside of fraud, we don't ask our brokers to buy back. So,
Right.
and if there's fraud that's exposed, that's more of a secondary banker mentality. So if that's for the non-del core out there, but the broker, if there's, an issue, the EPO early payoff, it's, that's kind of the challenge in the market, as a wholesaler. So buybacks, unless there's fraud or there's issues, EPOs, early payoffs, that's in it, or EPD, to Tom, early payment default, that's when we're going to dig in and go to the originator and say, did you not tell us something? But by and large, we've never pushed back one buyback to any of our
The brokers, yeah. And I would agree on the broker base, but if you're a lender and you have an EPD, that's a different story.
Correct.
Yeah. I think the biggest issue here is the relationship between the originator and the borrower. And the stronger that relationship is, the better chance that loan's going to pay. And so we would just encourage you to, after you close that transaction, this is like loan officer 101. But stay in touch. Stay in touch with that borrower. How's it going? Did you get your first payment notice? Do you know where to make the first payment? Do you know do you know how to make the second payment? Everything good? The loan closed. Stay in touch with that borrower. And what we find is that when we have potential issues on loans kind of out of the gate, the ones that perform the best are the ones where the loan officers have a really good relationship with that borrower. They solve the problem, and the borrower understands exactly what has to happen in getting those payments made.
And then, John, just to piggyback on that communication with the borrower, right? That shows you care. And then, you continue to communicate, you might get a loan from them. You want to communicate and stay in touch so you can continue to get repeat business.
Exactly.
There's a question here, just to echo what you said before, Andrew. This is from anonymous attendee, but all investors offer non-QM. What is the unique program they offer is what they're asking. But, two parts to that. Number one, there are a lot of investors, as Andrew touched on, that offer it. The folks on this call, and this is a marketing call. We want to educate and market our respective companies. We are all singularly focused in non-QM, and that is a big, big distinction in the marketplace. So just because someone has non-QM on their rate sheet is not necessarily the best. You may have a great relationship with them for your FHA, conventional, jumbo, whatever it is, but that doesn't mean they can do non-QM well, and they're gonna, confuse you and run you through the ringer, and it's an elongated process, in the decisioning making. As far as the individual, everybody's got their nuances and changes and programs, but it is a somewhat homogenized industry. We do a lot of ITIN. I think others may do jumbo, and, someone's hyper focused on DSCR. So, but creating that relationship with one of our companies on here is really the way to go to, fill that gap for you. So that's for you, Mr. and Mrs. Anonymous.
Yeah, I would also say there's a lot of investors that don't have non-QM. And the other day, Rob and I were on another panel, and this is the statement or analogy that I had. If you have to go get an eye surgery or go get LASIK surgery, are you going to go to the doctor, the optometrist that's brand new in the field, or are you going to go to the expert in the market who's been doing it for 10 to 15 years and who has a proven track record? Are you going to trust your eyes, right, with the new entrant? Or are you gonna trust the person who has a staff who's been there 10 years, has done 15,000, 20,000 surgeries, and has a 5-star review? I know where I'm going.
Yeah. No, but you know, Robert, you mentioned this, and I think it's a great point. You know, in the non-QM space, you're talking about nuance. This is that's where we all play. I would say a third of the loans that we close have some sort of exception on it. And when you go to somebody, to any investor, to any wholesaler that's doing mainly agency business, they're going to be less able to get those nuanced loans closed, and that's at least a third of our business. So there's a reason to choose to be selective with who you're sending your non-QM business to. Just because you got a relationship with somebody on the agency side doesn't mean we get more transferred appraisals from agency lenders trying to do non-QM than anywhere else. And you know, we don't get transferred appraisals from ACC or Deephaven. They don't usually show up here, but we get plenty from other agency companies who are trying to do non-QM business, because we're able to say yes on that exception, and that little bit of a nuance that might kick it out someplace else.
Or structuring the deals, right? Like the folks that are new to the market. That's the prime example I made earlier, where the bank statement's at 50%. They don't ask for the CPA letter, and they don't develop the assets. It gets declined. They pick up, for whatever reason, they pick up the phone and they call someone else, and one of us, and they're like, hey, this got declined over there. First thing we ask is, okay, how much assets? Do you use an expense letter? They say, no, they give us the information, send it to us, and we get the deal done. So, you know, I would caution the brokers and originators on this call to work with folks that are solely focused on non-QM, because you're going to get a best-in-class experience. You're going to get seasoned professionals who could help you in the space.
So, and I'm just curious, I want to get back to these questions, but my own curiosity here. So, Tom, can you do blended, so let's say, the 12-month, the 24 months bank statement don't quite qualify, but they've got a lot of assets. So can they do some bank statement, some asset depletion within the same loan? Absolutely.
So let's say you have $10,000 a month in income, right? 50% expense factor, you're at 5,000.
Yeah.
But you need 6,000 to qualify, and they have, let's call it $500,000 or $1 million in the bank or whatever. You can just use that asset divided by 84 months. That number is, you could add that to your bank statement income. Now that asset can be used to augment the bank statement income to qualify, and you don't have to deplete the asset. This is asset utilization. You're actually depleting the asset or pledging the asset.
So let me backstop on that and bridge to another couple good questions. And I know touched on that. What Tom's talking about is, and John touched on earlier, is making that exception. So in that case, they need to show income, so the DTI in terms of that is somewhat arbitrary on what someone can afford. When a company makes an exception and looks at that, and you look at the global picture, you're like, well, this, we'd like to see them have 6,000 a month, but they have 5,000. We can definitely qualify, and they've got these assets, and we know there's a source of repayment. It's about ability to repay. It's about proving that, and that goes to the point. And then I think this will be a fun discussion. People have asked, I see it multiple times, do they expect stated income to come back? And I'll tell you unequivocally, no. It's a bad product. The change product was a bad product. I'm not trying to bash them, but stated income is not good for the industry. There's plenty more. And that's why our market has grown, because it's healthy, it's proven, and it's been proven that you cannot manage that effectively the way that ran up to the last Great Recession. So I think this is a good topic, because people always ask this question, and I don't see any stated income coming back to the market.
I would tell you the reason why that no ratio kind of product went away is because of performance and liquidity. That's it. If you look at the highest delinquent securities or bonds that have been issued in the non-QM space over the last year and a half, a lot of it's that no ratio stuff. Like the top 5 has 4 of them or have the no ratio. So investors don't want it. Warehouse guys don't want to finance it, because if it sits on their line and they can't sell it, right? Then, that's a problem, right? So, but going back to asset utilization, I hear there's, one of the questions is about marketing. Look, the Dow just hit an all-time high yesterday, right?
Mhm.
People that have stocks and bonds values have gone up if you're sitting on bonds. So we have over 22 million people in the United States that are millionaires, and so what I would do, knowing that the stock market is at an all-time high. By the way, you don't need bank statements to qualify using asset utilization. You could do asset utilization standalone. I would be going to all the wealth advisors in my town and saying, hey, I specialize in mortgages for high net worth folks, and use a Deephaven flyer. You can reach out to me, I could give it to you, and you can put your NMLS and logo, and you have a flyer. And I would go reach out to all the wealth advisors in your county or surrounding counties and become the asset utilization originator for your market.
That right there, that's a gold opportunity right there. So appreciate that, Tom. And I don't know if you guys want to comment any more on this, but I want to go to the next question if not. Because I think actually, and I'm not to sound like a broken record about using non-QM focused lenders, but one of the questions is turn times. Because I'll tell you, so we've worked with a lot of brokers, a lot of our audience, come to us and they've shared actually their problems, with non-QM and their resistance to non-QM. Time and time again, I find actually that it's not having a lender that has a great process because they're not focused on it. One of the things they talk about is turn times. Turn times, it's with agency, it's somewhat predictable. Can you guys, share, 30 seconds on turn times, where, what you see actually in terms of an average for lenders. And Tom, why don't you start that off?
Yeah, I would say, look, on average, what I've seen in the industry, I've surveyed all our competitors, all my friendly competitors. You have anywhere from 24 to 72 hours. Some are even at 24 hours, right? If they're newer, they don't have a ton of volume flowing in. You got some guys that might be a little bit on the other side of that. For us, we're we try to be at a 3-day turn time. I would say all our hiring for Q1, Q2 and underwriting and processors and all that is being fast tracked to right now. Because last month we just had a record month for locks, and our pipeline is continuing to grow in all channels. And so, turn times, it's extremely important that you get those turn times quick and you get files decision, because they're looking for answers. Everyone in the transaction involved, realtor, the loan officer, title, everyone's a customer on that deal. So you need quick turn times, but that's what I've seen.
Everybody talks about 24 to 48, and it's about kind of where we're at as well. But the more important number, and then I'm going to come back to the loan officer, kind of their responsibility in it. So 2020 for the last 12 months, okay, and we just looked at these numbers here at NewFi. Our average turn time from submission to CTC is 21 days. Okay, 38% of the business that we're closing, it took 14 days or less to get to CTC. 68% of our business, 22 days or less. So the best thing that you can do as an originator, and Tom's alluded to this, and mentioned it specifically, work with a good account exec who knows how to help you package the file. If you're doing your job up front and you're sending in a file that's fully documented, turn times are absolutely no problem. We're closing loans in a week or less if you give us a full file up front. And so the key is, what happens is people think non-QM, and for some reason they think they don't need as many of the conditions that they would send on an agency file. Other than tax returns, you kind of need to document the file. You got to have assets, you got to have credit, you got all these things that normally apply. So the better you are upfront processing that loan, and this is a big issue because in a market that's shrinking, a lot of loan officers has gone away from using processors. They're processing their own loans, and the quality of the processing has dropped. And so what happens is then you get in a file that needs more help up front, and that makes it goes back to the underwriter multiple times and extends the turn time. So what we're finding on our end is, if you're processing the loan really well up front, we're closing in rapid time. So there's absolutely no issues, but the key is structuring that transaction up front with an account exec. They've looked at the transaction, and here at NewFi, we've got them all over the United States, and they're ready to help you put together a file in the way so that when it gets to that underwriter's desk, you've got a good, clean approval, and you can get clear to close quickly. That's the key, is right up front, get that transaction structured and then documented in that first underwrite.
Fantastic. Robert, anything in terms?
Yeah, it's Sun Tzu, Art of War. If every battle is won or lost before, and that's what John and Tom are saying. You do the work up front. We post them on LinkedIn, 10 and 11 days, CTC from closing. It's pretty easy when you're prepared. And that's what we're saying. We understand there's an arc of process, but you can do it. Prepare, get it in, move, and and it's easy as pie.
Yeah, just one more piggyback. The number one thing is making sure that file is completely, the way you submit it, it has all the necessary documents needed to get it underwritten, submitting a full file, making like the income docs, all that's extremely important when submitting a file. If you submit it with missing items, of course, it's going to take longer. So,
the other thing too, I think people think about on the non-QM side is that there's like this one thing, and they think we're not going to find it or see it or whatever, and it's like just if you just don't say anything about it, nobody will know. Like, we're going to find it. So you're much better off having that, disclose it right up front to the account exec, have that conversation so it's wide out in the, because then that way you're not going to multiple different lenders and getting that loan declined. Everybody's gonna run into that. Everybody's gonna find that one issue. The one issue that about is the one issue you should be talking about the account exec to the account exec right up front, so that you can deal with it and figure out a way to solve that problem.
Fantastic. Great. All right. So my next question, just because some people are asking about the P&L loans and bank statements. So if you guys can first off, explain the difference between a P&L loan and a bank statement loan. If you wouldn't mind taking that, Tom.
yeah. So bank statement loan, we're looking at personal or business bank statements. On the business bank statements, we can do 12 or 24 months. We look at all the deposits, all the the cash flow coming in, all the debits. We take the overall income divided by a 50% expense factor, and then we use that as the income. If once again, if the business has a lower expense factor, if, for example, someone is a consultant, they work from home, they don't have a lot of overhead, etc., they can get a CPA letter, and they could actually use that CPA letter. Let's say it's a 25 expense factor, so on $10,000 in income, instead of using 5,000, they could actually use 7,500 if they have the expense factor. On the P&L, I'll lob that one to John.
Yeah. So here's the great thing about the non-agency space. Everybody handles these loans differently. There's some commoditization of the product. 12 to 24 month bank statements pretty much looks the same kind of across the board. Everybody looks at income just a little bit different. People back out some things that are coming in. Everybody looks at expense factor a little bit different. But I think where the non-QM focused lenders thrive, especially here at NewFi. And we have 7 different ways to qualify a bank statement, a self-employed borrower. Okay, so 7 different ways. P&L is one of them. So a P&L loan, you're gonna get the P&L from whatever period of time you want. We require 2 months of additional bank statements to support the revenue coming in on that P&L. So we have a requirement that you get some additional documentation to support the income that's coming in on that P&L. But we have other options, and this is where we kind of keep coming back to this. But it's really important if you're going to originate non-QM business, is you have to have a good account exec who can help you navigate the different options. I talked about starting with the gross receipts of the borrower. So instead of starting at the AGI, you start at the top line. We have a program that allows you to get a letter from a CPA and that says, here's the top line revenue for this borrower for the tax. It's a little late in the year to do it but starting in next year, you're going to be able to get hey, here's the top line revenue for my borrower in 2023. And then you get me a couple of bank statements to support that income's still happening. And we can structure a loan that way. Tom's talking about asset depletion. We can do business with 10 borrowers that are just 1099. We have a trust distribution program. I mean, all sorts of different ways to qualify that self-employed borrower. So don't limit your mind to just a bank statement. Think about other ways to
But the question was, what Tom threw to you was talking about a P&L, the difference between bank statement and P&L. And the P&L, someone had asked this before, what's the difference between P&L and a stated loan? Well, first off, a P&L is prepared by a professional tax preparer. It's a third party using other sources of documentation. So it's not just a stated income. We're not asking, the borrower is not preparing this. It's a tax professional because they're going to put their license on the line. So that answers two questions. We still require 2 months of bank statements with that P&L to give some validation for those figures, but you're basically extrapolating the tax preparer is for that. So that's a P&L. It's a little riskier because you're not seeing the full picture that you would see with 12 or 24 months of bank statements, but it's a quicker path. And for the investors, we like it because we've got a tax preparer that has put their name and tax or their tax preparer ID number on the line. So we know it's been done by a professional. It's not just them going into their QuickBooks account and generating that. So that kind of answers both those questions.
Fantastic. All right. Another question. Someone asked, what is the DSCR program? We know a lot of people on here know, but let's do like a quick 30 seconds about what a DSCR loan is. Robert, you kick this off.
DSCR is an investor program. You're using the cash flow from the property to pay the mortgage. Boom, that's what it is. It's very popular. It's streamlined. You see a lot of it out there. The challenge is, rates are high and rents haven't caught up. So it's a challenge staying above that 1-to-1 ratio that you like to see. If your mortgage payment's $2,000, you'd like to see a 2,000 plus. That's where the investor markets. Do you do it below? Yes, we will look at those, typically with a little bit more skin in the game on those for an investment property. But that's as close to a stated income product that is out there, but it's for the investment and it's viewed as a commercial product.
What about if you're not born in this country? Can you still get the DSCR loans?
Absolutely. Love them. Do a ton of those.
Okay, fantastic. All right, John, what does DSCR stand for? And what is unique about working with real estate investors that you don't get when you're working with just traditional owner-occupied borrowers?
Yeah. DSCR stands for debt service coverage ratio, and it is a commercial underwriting concept that's been applied to the residential space. And Robert's exactly right. The ideal loan is one that's got positive cash flow. Positive cash flow means your DSCR is 1 or higher. If you have negative cash flow, you're losing money every month. That DSCR drops below 1. Here at NewFi, we offer 3 different buckets of DSCR, 1 or higher. 0.8 to 0.99, so you lose a little bit of money every month. And then we also have a program that's below 0.8, and so that's kind of the structure of DSCR. What we have found is that the loan officers that are focusing on DSCR are capturing DSCR market share. Okay, that's so you have people that you start doing DSCR, you get known for DSCR. Those investors will refer you to other investors, and that helps grow your business. It's the biggest piece that we find for people that are focusing on it.
Fantastic. All right. Next question. Something I'm gonna. This is one of the questions that just came in. I want to get this one because this is an important one, because there's a lot of originators out there that are in the same boat. As an LO, I specialize in first-time home buyers my entire short career. This year, I enforced why I need to diversify. What would you suggest in the non-QM world as I'm completely green? And I want to start off with this. And if you guys could just think about this, think about an elevator pitch. So give a short elevator pitch that an originator can say if they're going to a networking event. So let's say they have a networking event going on this weekend and they want to focus on non-QM. Getting on non-QM, what should they say? What should be the thing, the bait that's going to potentially get some non-QM loans? I don't know. Tom, you want to kick this off for us? You know,
Yeah.
what
A couple of things. I would say, look, the outside of the agency offering, I would say the product that where I specialize and I help a ton of borrowers in our market is, I help a lot of self-employed folks, entrepreneurial spirited folks. We have options to help. Now you're talking about first-time home buyers, right?
Well, so this person specializes in help first-time home buyers, but they're looking to diversify. So
Yeah.
basically, let me just say, okay, let's talk about that elevator pitch because this person
Tom's in a long elevator. He takes really high elevators. So let him know.
The penthouse, the penthouse suite.
So, all right. So again, Tom, yeah. So what would the elevator pitch be? You want to focus on non-QM loans. You want to bring in non-QM loans. You're at this networking event and Tom says,
Yeah, I'd say, look, non-QM is an opportunity to help put more borrowers into homes. It's plain and simple. It allows you to help all borrowers in the marketplace, not the borrowers that just that don't fit that fit the agency guides. And I'd go back to all those stats of all those people in our country that we're not that are underserved,
Yeah.
right? Including first-time home buyers. And I know all the products out there, and I educate the network on all those products. And if you're educating your network and your products and you sound confident in your pitch when you're out there, then people will come up to you and start talking to you about those products. So what I would tell this person is become a product knowledge expert. Leverage your resources with your investors, and become confident when you go out there and sell non-QM, because if you're not, people are not going to want to do business with you.
okay, Robert, I'm going to take yours, but I got to go to Tracy here. Tracy in the audience, you said this. I love this, Tracy. Thank you. I'm Tracy May, and I specialize in investor loans. I help investors review their current portfolio of real estate and make sure they are cash flowing, because cash flow is king. Tracy, and you are king or queen, depending on which Tracy you are.
Yeah. One other thing for Tracy, what I would say too is, I don't know if she's aware of this, but for all the other originators out there, if they want to target professional investors in a marketplace, there's the opportunity to do business purpose lending as well.
Okay, she's a princess, is what she said.
LLC. Oh, that's right, the princess.
Yeah,
Of
DSCR princess. We had a DSCR queen last time, I think. So
Yeah,
there's DSCR princess and DSCR queen. Hey, Andrew, you might. I know this originator doesn't mind me using his slogan, but the greatest elevator pitch for a non-QM originator is, when banks say no, I say yes. It is, and I don't mind sharing it because nobody's ever copied it, and it's just
That's from the 80s. That's from the money
Joe
store.
Boyum. Yeah. Your bank says yeah.
It's a great line.
Says yes.
I mean,
Here's the non-QM. Here's the non-QM.
Yeah.
All right.
And a lot of banks are saying no right now. They're saying a lot more. So
here's another one. This is mine. It's my gift to all of you. If I can't get you a loan, it doesn't exist.
Oh,
That's how you do it. So, well, I have a 500 score. I do. Well, great. I've got a hard money outlet. You're going to have to put down 50%. Multi-million dollars. Okay, it's all LTV driven. That's how I did that. So to the originators, non-QM, that's how you separate yourself. That's what I talked about before. That's the line. If I can't get you a loan, it doesn't exist.
Like it.
That's short awesome. Elevator. You can go up 2 floors on that. Not Tom's to the Twin Towers or the Dubai. What's the Dubai building, or Malaysia? One of those big ones.
How about this question about marketing realtors who possibly have non-QM clients? That's a good one.
Yeah. Okay. Let's go for it. Tom, yeah. since you're
so look, realtors are probably one of your best referral sources. When you pitch non-QM to realtors, don't pitch it as, hey, do you have any deals? I'd like to help you with deals. Try pitching it as a solution for the realtor for their own real estate portfolio. right? So very successful realtors, they own real estate. And I know plenty of originators that do realtor lunch and learns that educate the realtors on these products, hoping that they get a deal, from, maybe a buyer or one of the borrowers. But many times these realtors have deals and have investment portfolios, and they know other investors. So it's, realtors also work with a lot of self-employed people. So they work with, there's 1099, they work with high net worth individuals. They work with all types of folks, right? And then what I would focus on going into next year for everyone on this call, the originators, 75% of realtors in the United States, or excuse me, 75% of the listings are owned by the top 5% of realtors. The top 10% of realtors account for 90% of those listings. So make sure you're targeting the top 10% of realtors in the market that have 90% of the listings. Don't go after the realtors with only 10% of the listings. Be tactical on who you're targeting to grow your business in 2024.
The other thing too that I would say just real quick is that don't be afraid to share your referral sources with your other referral sources. Leverage your success with one, with the others. Get them together, have them start talking. It was a great idea from a broker up in Washington. He got all his referral sources together every month. It was about 20 people. They'd go cordon off a corner of a bar up in Washington once a month, and they'd go sit there and talk about their businesses. And what happens is then the CPA will talk to the tax attorney talks to the realtor talks to the investor, and all of a sudden you're starting to create value for them beyond just the mortgage business. Okay, so that's the other piece that's really important when you're trying to develop these relationships. Create value and leverage your success one with the other so that they're talking together. It's not just you telling them about how great you are. It's other people telling your story for you. So don't be afraid to get those people together in the same room.
Fantastic. Well, listen, unfortunately, we have 4 minutes left, and I want to just, I want to close this out. We are going to share the recordings with everyone. We're going to go back, make sure actually that we haven't said anything we shouldn't say, but assuming the ones that are still okay, we will share that with everyone. But there's some gems in there, lots of marketing ideas. And one of the things, so Tom was talking about really spending your time focusing on the top real estate agents. These guys all have access, to tell you who are the top real estate agents. So they could pull the list for you and get get you that. But I really thank you guys so much for joining us. This has been amazing. I feel like I've learned so much more about non-QM just from being a part of this. And let's just say goodbyes, and we're going to start, Tom, you first, then John, and then Robert, you'll wrap this up.
Yeah, thanks everyone for joining us for the last 6-part series. I would say make non-QM, a focus going into next year. Deephaven, we would love to help you. Reach out to me or Deephaven, you go to our site. And I'd like to wish Robert, John, and Andrew happy holidays, Merry Christmas. It's been great, to do this with all three of you. And so, thanks again for putting on a great show.
Yeah, no, I would definitely reiterate the same thing. One of the beauties of this is I hope we were able to share some knowledge and help you kind of close another loan. It's kind of what we're all about. But I have to be honest, I've learned a ton from sitting with this group and every 6 months and sitting down, and it kind of has forced me to go to another level in terms of my own knowledge and product and borrower and what non-QM is and telling that story. So I'm thankful for both of these guys and Andrew, you two putting this together, and for your audience asking all these incredible questions. It really causes us to think about the mortgage business in a different way. And I'm thrilled to be representing NewFi Wholesale, newfihowholesale.com. I'll throw my LinkedIn profile into the chat. If anybody wants to connect with me there, we'd love to connect with you. I know a lot of you are doing business with NewFi, and we appreciate that. But just an incredible experience with Tom and Robert, and I've learned a lot from both of you guys, and I appreciate you sharing your knowledge with me, and Andrew, you for facilitating this great conversation.
Fantastic. Last but certainly not least.
No, and it's kind of appropriate. I'm glad I could really help you guys as the Bob father of non-QM. Sharing the wisdom. I'm not selfish. I'm trying to make us all better as an industry. And I've met Tom before this, John. I've really enjoyed these webinars, and Andrew and I got a great history. But for the folks out there, I hope you got something out of it. We held the audience for this. That's always a good barometer. Non-QM's here to stay, and we've been doing it for we'll celebrate our 25th year this coming year. So we're excited to do that and partner. And I look forward to doing this again with Andrew and you guys, and having a beer with you all soon.
Fantastic. All right. Thank you so much for making this non-QM town hall series just a lot of fun. Some great questions. Appreciate it. You will see more non-QM town halls coming up in 2024. I hope you have a healthy, happy, and amazing holiday season. And I hope 2024 is your best year ever. Stay tuned for more great stuff coming out from both these three gentlemen, their lenders they're with, and of course, AmBiz and NMP. Everyone, stay safe. Have a great day.
Be good.
Thanks, guys.
Take care.